Shri Gurubhyo Namaha. Hi there, guys. So in this video, we are going to start with your section A of your part 2, that is strategic financial management. So your section A of CMA part 2 is titled as financial statement analysis. So now, what exactly do we mean by the word financial statement analysis? So financial statements, you know the 5 financial statements, right? You have your balance sheet, you have your profit and loss, you have your cash flow statement, you have your statement of equity, and then you have your notes to accounts, disclosures and disclaimers and notes to accounts. So you have your 5 financial statements. So how do we prepare these 5 financial statements? That is covered in your part 1 section A, right? So CMA part 1 section A already covers about the preparation and presentation of the financial statements. Then in part 2 section A, we are going to cover a different concept here. Here we are going to talk about the analysis of those financial statements. Like for example, if we give you the financial statements of Netflix, or if we give you the financial statements of Amazon, or if we give you the financial statements of Meta Inc, that is your Facebook, or Alphabet, that is Google. So will you be able to analyze the financial statements? Will you be able to compare one set of financial statements with another one? Let's say, can you compare Meta with Alphabet, that is Facebook with Google? And will you be able to come to some conclusions by looking at those financial statements? Okay, so what are you going to do there? You are going to use different ratios to analyze that. So what is the revenue growth rate? Facebook has grown by 8%, whereas Google has grown by 15%, or something like that. I'm just giving you some random numbers. These are not actual numbers in the financial statements. Just I'm giving you random numbers there, hypothetical numbers. So we are going to use the financial statements, and we are going to calculate different ratios, and then we are going to use those ratios to identify the financial statements information, and to analyze those financial statements. That is your section A of your CMA part 2. So let's go into the details of each component and each concept, not each concept, but yeah, all the topics. Let's try to understand those things. So you have 4 areas of CMA part 2 section 1. So what are the 4 areas section A? So the 4 areas are: the first one, which is talking about basic financial statement analysis. So here you have 2 topics. What are those? One is using the common size financial statements, and then the other one is using the common base year financial statements. I'll keep it very simple. We are not going to discuss the entire concept here in the introduction video, but common size financial statement means basically where, if suppose I'm giving 2024 P&L, okay, profit and loss statement, I'll say sales, and the sales number, let's say 10 million, that will be considered as the base. That means that will be the 100%. And any number following that sales figure, let's say COGS, cost of goods sold, is, let's say 8 million. That means my GP would be 2 million. And then my your SG&A, selling general and administration expenses, are 1 million. So my net profit before taxes, PBIT, profit before interest and taxes, 1 million. Let's say my interest component, or finance cost we call it as, is 0.3 million. That means my PBT is 0.7 million. And then my tax is, let's say 0.21 million. That means my PAT, profit after tax, would be 0.49 million. So this is the P&L. Okay, so instead of looking at these numbers, if we convert all of them into a percentage and say cost of goods sold 8 million out of 10 million, that means 80%. Gross profit 2 million out of 10 million, that is 20%. 10%, 10%, 3%, 7%, 2.1%, 4.9%. So here now I can say that these are just percentages expressed, same numbers expressed on percentage base. And what is the denominator taken? The basis is the sales figure, right? So in this case, this is called as the common size financial statement. So here what is happening? Now I can say that my finance cost is the 3% of my overall sales. My taxes are 2.1% of the overall sales. My cogs are 80% of the sales. I have a 20% gross margin and 4.9% of net margin. So everything can be easily expressed in percentage terms. That is called as the common size financial statements. Sir, profit and loss, you took sales figure as the base denominator. Then what about balance sheet? You take the total of the balance sheet, total of assets or total of liabilities and equities as the denominator. Rest all will be expressed as a percentage. That is called common size financial statements. So we can easily analyze the elements of the financial statements. Then what do we mean by common base year financial statements? Again, here base year means you are going to have a base year. Let's say 2020 is my base year. So 21, 22, 23, so on so further. So here what we are going to do is if suppose sales figures are there in 2020, we did 10 million. In 21 it increased to 12 million. In 22 it went to 14 million. In 23 it went up to 20 million. So here these numbers do not make complete sense as such. So what I'll do is I'll show this as a percentage. So this will be considered 100 percentage. That means 12 million by 10 million, 120 percentage. 14 by 10 million, 140 percentage. 20 by 10 million, 200 percentage. Now I can say that, okay, this year it grew by 20% compared to the base year. Here it grew by 40% compared to the base year. Here it grew by 100% compared to the base. This is not growth rate. This is not annual growth rate. This is over the base year. That means a common denominator is taken here. And the common denominator is the 2020 base year. That is called as common base year financial statements, where we just express everything as a percentage. Okay. So that is your first part of your CMA part 2, section A, financial statement analysis, basic financial statement analysis, unit 1. So next, unit 2 talks about your financial ratios. Now what are financial ratios? As we just covered, so numbers cannot be compared with one another, but ratios can be compared with each other. So what we'll do is we'll calculate various ratios. So what are the different categories of ratios that we will calculate? First one is liquidity ratios, means your working capital ratio, your current ratio, your quick ratio, your asset test ratio, cash ratio, receivable days, payable days, inventory days, net working capital cycle. All those things related to your day-to-day operations will be covered in liquidity ratios. Then in leverage ratios, we are going to talk about capital and debt equity ratio. Then we are going to talk about your interest coverage ratios, how well you are able to serve your interest, how well you are able to serve your debt and all that stuff. Then you have your activity ratios, also called as operational ratios. So operational ratios means your entire activity inside your company. Okay, so like for example, just give me a second. This is, yeah, sorry. Yeah, the elements which are used inside the liquidity, like for example, your receivables, your payables, then your inventory turnover days, your cash cycle, your operating cycle of your business, all of these are covered in the activity ratios. See, technically speaking, I would include activity within the liquidity itself. I'll cover activity and liquidity together, but yeah, those are separated out for your syllabus purposes. Then your profitability, your GP ratio, your NP ratio, your PBIT, your ROC, return on capital employed, your return on investment, then return on equity, then EBITDA, earning before interest, depreciation, tax and amortization, all these are covered in the profitability ratios. Then market ratios, your PE ratio, price to earnings ratios, PB ratio, price to book ratio, then your EPS, earning per shares, and then diluted EPS, dividend yield, payout ratio, return to the equity holder, all those things. So basically your financial ratios are different ratios which are calculated and are used for analysis of the financial statements. Then profitability analysis is expanded further. Yes, we already covered profitability ratios on the unit 2, in the unit 2, but here profitability analysis theoretical discussion will be there. Like for example, how are you measuring your income? So if you are using different denominators, your ratio would be changed, right? So how are you, which types of measurements are you using for calculating the income? How are you analyzing your revenues? So which method of inventory are you using, FIFO method or weighted average method or LIFO method? So whether are you calculating return on investment or return on assets or return on net assets, or return on assets after depreciation? So how are you calculating it? So the disclosures related to that and various intricacies inside that will be covered here. So we are going to analyze the cost of sales, your COGS, opening stock plus purchases minus closing stock plus any other direct expenses, production costs, etc., etc. Then we are going to talk about the analysis of your expenses, whether your indirect expenses are increasing or whether your indirect expenses are decreasing. All that stuff will be covered. Then we also cover something called variation analysis. So in variation analysis, we are going to talk about percentage growth. Okay, so for example, if a company is growing from 1 million first year to 5 million in the second year to 25 million in the third year, so you can see every year 5x growth is there, right? The turnover is going 5x. So can I assume that after 25 it will go to 125, and 125 to it will go to 625, and 625 to 3000, 125, something like that? Will it continue this 5 exponential growth? Maybe, may not be. So we have to talk about the sustainability of that growth. Okay, that is what is covered in the last one, that is variation analysis, sustainability of the equity growth and the revenue growths. So that is your next topic, that is regarding your profitability analysis, unit 3. And the last one, unit 4, which is special issues relating to the ratios. Because understand something, ratios are very easily manipulatable. Anybody can just change a simple number, or anyone can easily how do I say this, anyone can just do a single transaction that can completely manipulate the ratios of the company. Like if I tell you, just imagine this, you are at the end of the financial year, okay, let's say 31st of December. So you know that your sales are below the target, you are unable to achieve your sales target growth. So you immediately called one of your friends who is working in another company in procurement department. Okay, so you called your friend who is working in procurement department, that means purchase department, and you told him, buddy, you know what, my situation is very bad, I am unable to meet my target this year. I think my manager would be very unhappy with me, so could you help me out here? So your friend said, okay, how can I help you? You told him, do one thing, just send me a purchase order for 3 million, okay, or maybe for $30,000. My target is short by $25,000. So if you can buy $30,000 worth of goods from me, my target would be completed. So he said, but see, I have to answer to my company why I am purchasing this $30,000 worth of goods. So you called him back and you told him that, no, I don't want you to actually buy the product from me. You just send me the purchase order. I will send the goods to you. You immediately reject the goods when it comes to you. You say that your quality issues, or you can say that you have already procured the inventory from somebody else, whatever it is, you just reject the goods or just send purchase returns, and I'll manage it with my sales team, and I'll say that okay, fine, you can accept those returns. So basically, for the buyer, there is no transaction. We just gave an order, we received the goods, and immediately sent it back. But for the seller, 31st December, they recorded sales of 30,000. On 5th of January, they got 30,000 sales returns, but that is for next year. So I'll worry about that next year, not in this year. For me, this year, my target is satisfied. So I can just do one transaction to manipulate my sales ratios and my growth ratios and my turnover ratios. So we are going to talk about those kind of scenarios in the special issues. So how foreign operations will impact your ratios. Like for example, dollar rate was 80, it went up to 84. I had 10,000, $10 million receivable. So let's say in INR, 10 million into 80 is 800 million, right? But at the end of the year, the dollar rate has increased to 84. I still have $10 million receivable, but now dollar is 84 rupees. So my receivable bill will become 840 million. So 40 million of gain, 40 million rupees, that is 4 crores. I got gain by doing nothing. The receivable is 10 million only. It's not like I sold more goods or anything like that. Nothing. This 4 crores is just foreign exchange gain for me. So your foreign operations can also impact your profitability. So we are going to talk about that there. Similarly, if the prices are changing, obviously your sales will improve. Last year also you sold 10,000 units. This year also you sold 10,000 units. But last year each unit was $2. This year each unit is $3. So sales is 20,000 last year. Sales is 30,000 this year. So sales is showing 50% growth. But technically speaking, they have zero growth because both years they sold 10,000 units only. The growth is in the price, not in the quantity sold. So effects of changes in prices and inflation. This is nothing but inflation only. Na $3 product increased to $2 product increased to $3. That is inflation and changes in prices only. So those are your 2 points. Then if you are changing your accounting treatment, for example, you are going from FIFO to LIFO, then inventory will differ. If the inventory balance is changed, the cost of goods sold will change, because in cost of goods sold you do opening stock plus purchases minus closing stock. So closing stock value will change, opening stock value will change. So obviously COGS will change. If COGS is changing, then GP margin will change. Then every other ratio will be impacted. So a change in accounting treatment can also impact your ratios. Similarly, there is a difference between economic value and income. Sir, what do you mean by that? Very short, depreciation, straight line method. Let's say we have 10 million worth of asset and expected life is 5 years. That means 2 million per year is depreciation, right? Okay. So in your books of accounts, you will record 2 million as a part of cost of goods sold because it is a part of the machinery cost, machinery depreciation. So it is part of the cost of goods sold only. Now my question is the actual reduction in the value of the original asset, is it really 2 million? I know 10 million divided by 5 years is 2 million. That is numerically correct. My question is, do you really think the actual value of the asset has decreased by 2 million? It could be 3 million decrease, or it could be 1 million decrease also, right? Or maybe the value of the asset actually increased in the market, revaluation gain. So that is the difference between economic value and calculations in your books of accounts for income, profit, and other calculations. Last one, the quality of earnings. See, quality of earnings means having sales growth is good. Imagine if I'm talking about an educational institution. Okay, if the sales are increasing, that means if the number of students enrolling are increasing, that is called as increase in the earnings, which is good. But if the number of students passing the exam is decreasing, that means the quality of your service is very bad. That means the quality of your earnings is not good. So What do you mean by quality of earnings? See, when your students are unable to pass the exam, what will happen? You will get a bad reputation in the market. So automatically your future sales will be impacted because of that. That means your current earnings growth is not sustainable for future. Correct? So that is called as quality of the earnings. We have to see whether the sales and profit that we are earning, are they sustainable or not? How is the quality of it rather than just the numbers? So that, my dear friends, is your section A of part 2 of CMA Strategic Financial Management, section A, financial statement analysis. So to summarize, we have 4 topics: basic financial statement analysis, financial ratios, profitability analysis, and special issues relating to the ratio calculations. So I'll see you in the lecture series soon. So until then, keep smiling, take care, stay safe, bye bye.